Jag är kvar här fortfarande efter förra presentationen. Robert Taube heter jag, analyschef på Erik Penser Bank. I'm very happy to welcome John Dysocki to the conference. John is an early stage investor and investment partner at Giant Ventures, right?
Yeah, correct.
And I think that either personally or through Giant, you're involved in, for one thing, Heart Aerospace, which we may talk about a little bit later. But for now, you will talk about early stage investment.
Absolutely.
So very warm welcome.
Thank you. So let me practice my Swedish. Don't laugh. Jag heter Johan. Jag kommer från California. Min fru kommer från Skåne. Vi har 3 barn. And that's all I can say. I'm super excited to speak with you today. You know, the landscape of climate technology and venture capital has really changed in the last couple of years. But a lot of this has come about through activism. But I promise you, I'm not going to do a climate doom presentation today. I'm sure a lot of you have heard about, you know, all the scary numbers about where the climate is heading. And I don't want to knock all the work that social justice people have done to sort of bring these topics to the forefront. But I promise you that's not today's presentation. This is a business conference. So what are we going to talk about? I want to talk a little bit about what Cleantech 1.0 was and the investments in that world. I want to talk about the new Climate Tech 2.0 and where things are going. I want to talk to you a little bit about venture capital and this really great word called ZIRP, which is the zero interest rate policy times of the last 20 years, and then how those things come together and what Giant Ventures does in those areas. So, about 20 years, there was a ton of headlines around clean tech, okay? Especially in the United States. A very famous venture capitalist, the early investor in Google by the name of John Doerr of Kleiner Perkins, ushered in a new wave of what's called clean tech investing, okay? Obama and Bush had signed in tens of billions of dollars into climate technology infrastructure, and we were thinking, wow, this is going to be a huge boom in the market. And $100 billion was invested in the United States between Obama and other sort of politicians, and over $25 billion of venture capital went into the space. Now, thousands of companies got started, and the vast majority of them failed. And there was a lot of problems with that last wave. So you can see this was like a classic boom-bust cycle. What this graph shows is between the period of 2006 to 2011, so much capital was put into early-stage climate technology companies. And a few of these major venture capitalists almost went away. So 2 of these names, Kleiner Perkins and Khosla, who are now household names in the venture capital industry, almost went bust. And they bet on the wrong companies at that time, right? Fisker versus Tesla, Kior versus First Solar, one of the biggest solar producers. And so the big question is, what did we really learn from that last cycle, right? Were there lessons that we could take away from that cycle? Because a new dawn has arrived, right? There's generational motivation from consumers, millennials, Gen Z. There's new large government subsidies that are coming through on a global scale. And there's really cool breakthrough technologies. The big question is, did we learn anything from the last cycle? So with my friends at Bessemer Venture Partners, we looked at the major lessons that we could take away from that last cycle. The first one is, and I cross out altruism, is that you can't just deliver a product that's green and clean to make people feel good. It has to be cheaper, better, faster, full stop, okay? Your business model has to be able to scale. You can't just throw lots of capital into these business models and expect that it's going to work. And you need to leverage regulators. You can't, in technology, there's this concept of move fast and break things. You can't necessarily do that with climate technology because you have to work with regulators. There's also concerns around copper and cobalt and all these big supply chain issues. So you have to understand whatever you're producing needs to consider any potential future supply chain shocks. The other problem with the last clean tech wave was that there were science fair projects where people would be in a lab for years and years and years with no real business milestones to be expected. So they would be given large swaths of money, but there was no real business case for what they were working on. And we've returned to the lesson that we learned in this next cycle is milestone-based funding. And I'll get into a little bit of what that means. But at each progressive commercial execution or pilot, you get an additional amount of funding. We need to use data not as a part of the business, but we need to use it as a main driver of the business. And finally, let's use software as the primary component to drive a lot of these businesses. So obviously a lot of lessons learned, and my hope, crossing my finger, is that we will actually implement those lessons this time around. So if we look back historically, one of the biggest culprits of CO2 emissions, obviously, the big bad USA, right? Now that I live in Sweden and I've done Vasaloppet, I'm 5% Swedish, so I can make fun of USA a lot now. But a big culprit of some of the issues that were caused, China and the EU as well. Today, it's actually now majority China, and USA and EU is slowly dwindling, which is really good news. But again, there's really big areas that can be decarbonized. Legislators around the world are making big change, right? So out of nowhere, the United States did the Inflation Reduction Act, which put $400 billion into green companies. The EU Green Deal, over $1 trillion over the next decade. The Brits are very far behind for some reason, but apparently they're going to have new legislation coming down the pipe. And China, it's hard to understand whether their numbers are accurate, but they've put forth some really compelling, legislation. So this is good news. What it means is these subsidies are incentivizing companies to create new technology. So if there's a buyer in the form of a government, or there's a lower cost of production in the form of these subsidies, that just creates a much easier starting point for a lot of the startups. So where is all of these emissions, where are all the biggest culprits of emissions? It comes from everything that buildings, transportation, industrial systems, and agriculture. When I look at that, I think there is a massive opportunity, right? These are the largest asset classes in the world, especially real estate, manufacturing, agriculture, transportation. These represent very, very large asset classes, and the folks who are in this room, the folks who are at this conference, are involved in these industries and can drive change within those industries to make them cleaner and greener. So that means there's big opportunities within those areas, right? You think about the shift to renewable energy, everything from green hydrogen to nuclear. You think about energy efficiency within buildings. We talked about hard aerospace, electric aviation, Einride, electric transport of goods and services, and things like regenerative agriculture. These are all really big business opportunities. And you don't have to, you might get a little blind staring at this chart, but these are all areas that me and a close friend of mine, David Rusenko, have put forth for entrepreneurs to focus on within the industry. Meaning, let's invest in all of these separate subsectors for small up-and-coming startups, everything from grid technology to electric vehicles to storage of energy. These are all areas with which startups are now addressing, which is very exciting. So what's the equation look like, right? We need to decarbonize to get to net zero. That decarbonization equation looks like 40 gigatons of CO2 released a year. 12 of that is going to be renewable energy. 11 of that will be energy efficient buildings, 9 in carbon capture, 8 in reforestation and regenerative agriculture. All of that is achievable. And I think when you hear about the climate doom and all the concerns around it, these kinds of equations and the entrepreneurs who are building within this system give me, as somebody who's a day-to-day investor, a lot of hope for the future. But I feel like there's kind of a Steve Jobs moment, right? Wait, there's more. One more thing. What if I told you that a lot of what this is doing is not just about getting to net zero? if we can get to unlimited energy, right, and unlimited computing power, and we're talking about obviously all the areas within artificial intelligence and computing power, I think that it unlocks a new level of society. Okay, and this was a artificially generated picture by Midjourney, which is a very cool tool that a lot of people are using nowadays. And I wrote to it, to the AI. I said, show me a future in which we solve all of our climate problems, we have unlimited computing power, and we can create all sort of sustainable transportation. And this is what it came up with. I thought that was pretty cool. So, we don't have to be doom and gloom. We can look forward towards the next generation of people who are living on the planet and make things better. But right as things were starting to look good, the Federal Reserve and all the banks put the brakes on the economy to quell the inflation. So I would be remiss to not mention what's happening kind of on the ground in the economy, right? Like all of that is very exciting. There's all this great future, sort of potential, but what's the reality? So in our industry, venture capital, we think of what was a zero interest rate world, and now we think of a post-zero interest rate world. Completely different realities. So this has been the sharpest rate hike in 40 years, and so I think that reversion to a mean has really brought gravity back to business. NASDAQ dropped 35% in a year, which echoed the dot-com bust, and private funding within the startup community, both early stage and growth, dropped precipitously. So why the sudden drop in values? Maybe all of you are econ experts, but here's sort of the basics of it. Startups are a bet on future cash flows. When a company comes in with a deck and an idea, they're not going to make money for a long time, right? So you're betting on them to be a really big company in the future. When the present value of those future cash flows are considered, it's an inverse of the interest rate. So as interest rates increase, the present value of those future cash flows diminishes, and the value of startups go down, right? So not only was the value of those companies going down, but the volume of companies coming out were going down. And it created essentially a sudden shock to the market. Now, one of our mentors, a close friend of ours, is Sequoia Capital, considered widely one of the best venture capitalists of all times. They posed in 2009 a very similar presentation to what they just recently posed, which was RIP good times, right? All these companies were raising all this money, everything was very fun, and then it all stopped. And the same thing has just occurred in 2022. They titled their presentation The Crucible Moment, right? And a crucible moment is, how is this going to define the companies? I think, more locally, we saw Klarna's valuation drop by almost 70%. This is an example of some of the pain that's been experienced in the market. Now, a lot of the best companies moved quickly to sort of tighten their belts, right? That means, unfortunately, layoffs, reductions in costs, all sorts of things like that. And by doing that, you kind of avoid a death spiral, right? And a death spiral is a constant series of layoffs and causes a lot of cultural pain for companies. I would argue that this is actually a very good thing for the market. It's kind of healthy, right? We were all getting fat and happy on sugar and beer in the last cycle. And now we're going to the gym, we're eating healthy, and this is very good for the startup ecosystem, right? Because, first of all, startups are very, very hard, right? So it essentially eliminates a lot of the tourists who might not actually be up for it. Follow-on rounds, the next round of funding for a company, is not always a sure thing. And in the past, it was almost like it was. And this concept of staying ramen profitable, which means you have enough money to basically buy noodles at the market, that's as much as you're making, until you actually achieve real milestones. This has returned back to the way things that are. And finally, a lot of companies really value investors who've been in the market and existed before having run a company. And so that's back in demand. So when you take all of those influences together, right, clean tech 1.0, climate tech 2.0, the change of venture capital, and a return to normalcy, I would argue that right now investing in climate technology startups is a bigger opportunity than software and the internet, okay? The Fortune 100 companies of the next decade or 2 decades are gonna be the hard aerospaces, are gonna be the Einrides, they're gonna be, you know, whatever comes after Tesla. And the reason is because of all of those things that I mentioned, right? You're getting better quality startup founders being built during a difficult time. You're getting the capital and the infrastructure and legislation to support it. We've learned a lot of hard lessons in the last cycle. And there's investors like myself who've been through the trenches to help to guide entrepreneurs to not make the same mistakes of the past. So I'll do a short commercial and then we'll do Q&A. What is Giant Ventures? We are a purpose-driven fund. We focus on investing in the best founders within climate technology. We promise to our investors top-tier venture returns and impact at the same time, which is kind of unique. Our plan, we're already well on this way, is to deploy about $1 billion into this category over the next decade. And we really focus on being purpose-driven and also delivering high financial returns. There's been a past of concessionary impact funds, and that hasn't really worked and served the market very well. And our peers within the venture capital industry aren't fully focused on these problem areas. We cover the US, UK, and the Nordics. We believe these are the areas that are the most forward-thinking when it comes to climate tech. And we also cover all sorts of different areas within climate technology. Everything from regenerative agriculture to smart cities to net zero buildings. Any company that's building software and hardware combined to solve these challenges that has a really great entrepreneur will invest in. This has led us to being backed as a fund by some notable investors, the Danish Sovereign Wealth Fund, BMW, Rothschild, Stepstone, and then the CEOs and founders of some major companies. And a lot of them are encouraged by all of these forces coming together. We have a seed fund that invests at the very early stages, and then we have a growth fund that comes along in the sort of Series B timeline once companies have started to scale. I'm not going to go through all of our portfolio companies, but we cover a lot of areas, everything from ocean mapping to synthetic biology to EV marketplaces, and we want to have a diversified portfolio to cover all these areas. One of the most exciting companies comes out of Nordics. It's called Agreena. Now, 4 years ago, when Simon came into our offices, he said, I want to convince farmers to make their land green again. And it was like, this doesn't sound like a tech startup. It sounds like a farming company. But he had created a marketplace where large buyers who wanted to decarbonize would pay farmers to return their soil back to green land. And that actually sucks a lot of carbon out of the atmosphere. In fact, 9% of all greenhouse gas emissions comes from farmland. So if Agreena scales around the world, we solve 10% of that carbon equation. And so it's startups, in our mind, like Agreena, that can solve this problem. Now, they're also doing very good from a revenue standpoint and growing very quickly. So you can do well and do good at the same time, which is exactly our sweet spot. Another company we're really excited about is WaterPlan. Water helps companies, corporates, NGOs to predict water usage using artificial intelligence. They've gotten companies like Amazon, Coca-Cola, InBev, who had no idea how much water they were using, to use their platform and reduce the amount of water they were using and be super efficient with how much they used. So far, performance has been good. Don't have to go through this. This is from a prior presentation. And finally, we always promise to our investors that we will deliver impact in addition to these financial returns, right? Trillions of tons of carbon abated, billions of gallons of water saved, and that's our promise to both our investors and the world that we live in. So that's it. That's the presentation, and happy to take questions.
John, thank you very much. let's open up for questions. Anyone?
Don't be shy. If you want to ask in
Don't be
Swedish,
shy.
that's okay.
All right.
I have a translator.
So let me ask you. So being a climate tech investor, looking at, for example, the U.S. market and the Nordic markets,
Yeah.
do you see differences in terms of how investors interpret cases here or in the U.S.
Yeah.
Or do you see, the companies active in those two markets different in any substantial way?
Sure. So I was born and raised in Silicon Valley, around startups my whole life, and then I moved to Stockholm. My wife is Swedish, as I mentioned, and I got to meet a lot of really great Nordic entrepreneurs once I moved here. There's a big difference between the founders, right? U.S. and California-based founders will tell you that they're going to change the world. Then they haven't even done anything yet, right? It's like very overconfident. Nordic founders will have already done a lot and say, well, my startup is very small. It's not a big deal. Sort of jantelagen, right? This is the concept. And so there's probably a good intersection between the two, and I think a lot of them know it. What investors are seeing is that because there's this Nordic sensibilities of taking care of the planet and decarbonizing and having sort of government involvement in decarbonization and clean energy, that most of the Nordic founders who are working in this space have a great platform already to start from. That was not the case in the US for the last decade, and obviously I told you all about the clean tech issues that happened in the past. So investors were largely scared off there for a while. And they were investing in weird things like cryptocurrency, in areas that I think largely weren't that important to society. That's now changed. So I think the US and the Nordic companies will be the leaders within this sector for the foreseeable. And I think a lot of that comes down to just the sort of entrepreneurship legacy of this country and other Nordic countries as well.
Let me also ask you about your investment process. How do you screen? How do you find potential companies to invest in? What do you look for? What's your time frame? And to what extent do you actually take an active part in running the companies?
Yeah. So a close friend of mine, Gustav Alstromer, who sits on the board of Heart Aerospace, is a partner at an accelerator called Y Combinator. Y Combinator is essentially a university for startups to learn how to build a company the right way, and then they get an investment in that process. So every 6 months, there's a new cohort or batch, and I help Gustav review hundreds and hundreds of applications. And those applications are written word or a pitch deck, and it's just the entrepreneur's chance to explain their business, okay? You can tell within like the first, 2 minutes of reading something, how well the person knows what they're working on, how much their life has led up to working on this thing, how much their traction is so far, right? We come in really early, so we're looking mostly, about 70% of the decision is on the founder. Has the founder accelerated in other areas in the past that's shown a little bit of grit and sort of high slope and high growth? Have they been able to sort of consistently rally people around them to build a company in the past? There's a long list of criteria that we decide on. We also need to have a market that's large enough that is addressable by a software-enabled solution. And we also need to believe that the exit, right, the outcome, whether it be IPO or merger and acquisition, is large enough to justify an investment by us. Once we invest, we're very old school. We're very involved. We're very concentrated. But we've all been entrepreneurs before at the partner level. We've done everything from zero to IPO on the partner level. And what we try to do is get involved when they need our help, but get out of the way when they don't want us to be involved. 92% of VCs in Europe have never started a company. And what that means is a lot of them don't know the right times to be involved in the company and or don't know what the entrepreneur is going through during those times. So we get a lot of positive feedback that we have, I guess, more empathy for the founders than an average VC. So we try to get pretty involved. We sit on the board, and then as the company scales to a certain stage, and they get new sort of larger investors as they go, we might be less involved, but it really just depends on how well they're doing.
And the time perspective can be 5, 10, 15 years?
Yeah, so we raise a 10-year fund.
Yeah.
We have a 3-year investment period within the first 3 years where we deploy the majority of the capital. And then, our expectation is that exit happens within the first 7 to 13 years. And that's typical for an early stage company. If you're coming in at the later stages, Series B, Series C, growth stage, or if you're doing private equity and taking companies private, you can usually do a shorter time horizon. But we really want to give our founders the time. Simon is a perfect example at Agreena. He came in with nothing more than a deck and a few customer calls, and now he's doing 40 million of revenue per annum, going to 80 million of revenue per annum. So we want to give him a couple years to get up to speed, and then the sort of escape velocity just really starts to happen.
How has the climate changed to find interesting potential investment objects over the last 10 years?
Yeah, I think a lot of the major venture capitalists were scared off by this market by the last cycle. And so 3, 4, 5 years ago, we kind of had it like it was a little secret, like don't tell anyone. And now they all have a climate practice within the major VCs. And then new VCs, existing VCs have created practices. So you take Norhuen or North Zone or Creandum. They all have areas within their funds that focus on climate as well. And then there's new funds that are coming out. So it's become more competitive. But if you've been consistently sort of investing in the market and have some of the better companies within your portfolio, that becomes a compounding effect because the founders typically want to work with the sort of investors who've done the better investments, if that makes sense.
Yeah.
And it also is really helpful because we want our companies to have new follow-on investors that are sort of very credible in their generalists, right? So they might necessarily just have climate as one of their areas, sectors they focus on. So that's good news for us, is that more people coming into the market means more assistance for our companies.
So, and finding companies, there's plenty of potential objects for you to find out there. It's not like...
Not plenty of good ones. There's a lot of companies being started, but very, 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 very few that will make it to a very large scale. So you do have to be very selective, and you do have to realize this industry works on what's called a power law of distribution. A power law distribution is that a small percentage of your investments will create an outsized return for your portfolio. And so because startups are hard, there's a high failure rate, which means you need to be able to tolerate that. You also need to behave well as an investor when those things go wrong, because as soon as you are not well behaved, that word gets around, and then other companies don't want to work with you. And obviously, you want to continue to reinvest in the companies that perform very, very well. So that means you need to have a close relationship with those founders, having added value to them to the point where when they're willing to take on more capital, they only look within a small circle. And that's really the key to accelerating your returns.
So when you approach a company for the first time, or when you invest in a company, what do you bring the first day as an add-on value, except for the capital?
Good question. So we spike very heavily on a few main areas. The first one is narrative. So a lot of our founders are highly technical engineers, scientists, and they have trouble articulating what their technology is to press, to employees, and to potential new investors. And so we sit down with them and we do a narrative workshop. Right? What is it that you're actually trying to convey to the market? And we help them to get their first, Bloomberg, New York Times, Wall Street Journal article, right? So that's a big milestone moment. The second thing is how to hire properly, right? Don't just hire your friends from university. Don't just hire, somebody with a pulse off the street. Really creating a critical sort of analysis and process of your risks of your business, and then add the right people to your team to de-risk your business as you go. The third thing is we see hundreds of pitches a week, and we're helping multiple companies raise capital at the same time. A founder might only raise 4 or 5 times in their company life cycle. So it's a very weird process for them to learn and to get good at. And so we coach them through a fundraising boot camp on how to prepare for that next financing and what milestones they need to hit. And then the fourth thing that I think is the most important is a shoulder to cry on, right? So we've all run into brick walls in our business careers. We've all, figured out ways around them. And so entrepreneurs are inevitably going to face more and more of those as their company scales. Mm-hmm. And so they need to have somebody that they feel they can trust and come to with their problems. And it's not just this board of directors who they present to that aren't really very helpful. And I think we can say that with a lot of credibility because we've run companies before that are in similar areas. And I think that's really helpful for founders.
And what's
but they mostly want the capital, I'll be honest.
So in terms of numbers of companies that you're involved in, what is the historical hit ratio normally?
Yeah, sure. So before Giant, I had done about 50 investments, and 5 of them have gotten over a $5 billion or a $1 billion valuation. But you can make it to $1 billion and then still die. So it doesn't necessarily mean that they're going to win. My expectation is probably 1 or 2 of those will make it to IPO. At Giant, we're on our second set of funds, and we defined very breakout companies within our fund as what's called a fund returner, meaning it will do so well that it will return all the capital to the investors that have invested into the fund, and then some more. And I would say out of the 25 first investments we've done in the first fund, we have probably 4 that are fund returners. And then it really operates on a bell curve, right? So there's a small subset that are doing extraordinarily well. There's a middle that are doing okay, and then there's a small amount that are doing awful. So you just have to think of it that way.
So a question now: if you were to choose between getting as much energy out of a clean tech or new tech company, mm-hmm. as opposed to one that can save, you can have the same production levels, mm-hmm. but you consume less energy. Mm. How would you reason about these 2 business cases?
I think the question is like one that does better for the planet versus one that makes more money. Maybe. Yeah. Bottom line, it may come down to that. But the one thing is, okay, we consume more energy, but in a cleanish way. Yeah. Yeah. The other way is we save energy, so the energy level we consume goes down. Okay. We don't know the right answer, and I think that's why we diversify into many different bets. So let's take a state like California or Texas in the United States. They have massive energy grid problems. So we've invested in grid, sort of off-the-grid battery storage, which allows people, if there's an issue with the grid, to have their own stored energy that they can pull in on. So that's sort of like energy savings. And then on the other side of the equation, we've invested in Field, which is an energy producer that uses all sorts of grid technology to save and produce more energy. So we kind of try to do multiple, and that's the benefit of sort of diversifying across, the asset class, if that makes sense.
Okay.
Yeah.
Great.
Cool.
Can I ask you a question?
Sure.
Are you fully 100% focused on climate, or is it any other big trends you're also investing in?
Yeah, so we do a small set of investments within healthcare as well. And those are largely, our belief is that, part of sustainability is to have a healthy population so that people can work properly. and feel good about sort of living a long life, and then we will also do some investments within what we call